Don't do it, guys. Don't place trades based on what you see here. Please consult your own financial advisors and do your own due diligence. All right, with that said, let's go. All right. Yes, somewhat of a bad day. I did predict. Oh, look, it just ticked. The daily chart. This is unbelievable. This is 3 days in a row. Anyway, somewhat of a bad day. I lost a little bit of money. I thought my account value was gonna go up today. Didn't. But today we're gonna talk some economics. All right. So stick around. And more importantly, this article right here. I've read it, and I'm gonna give you guys my opinion on it. First, what happened in the markets. This little drop right here. I'm back to 33,488. So still a little bit up on the week, but not by much. If you remember, I started like 31,170, so up about $300. The reason being is one of the main reasons is the options, EXK option put. The 12 cells that I have, they just ticked upwards. They were 35, and then now 48, so that's a huge swing. All right, actually they started at 40, so they were all the way down at 35, so I was plus. Now minus, look at that $120 swing right there just from that. They're crazy. They can tick up and down, it's insane. All right, moving on. There's a little bit of discount here on Cameco, down a percent, so maybe some of these put sells might be worth it pretty soon. There also happened to be a little bit of pullback on the uranium ETF, 0.5%. Apple was up huge today. It was only ended up like 1% up, which again pisses me off, right? Because only 12 shares. I logged in today, I looked at this, and I'm like, what? Another 2.5%? What? They're already over a trillion, by a lot. And now another. Anyway, that's enough Apple talk. No more Apple talk. So this guy over here. Well, before we move on to the portfolio, yeah, nothing special. All right. Oh, and I still haven't used that $1,000 here, but what somewhat offset my losses is this $30 dividend that I got from my emerging market fund here. Let's go to the account so I can. Oops, what did I do here? Let's go to the account so I can show you how how much money I have in it. It's okay. Why isn't it showing? Oh, this one. Oh, sorry. All right. So $2,300, and it's giving me $30 dividends per month. But I think it has a set dividend. In order to reach that, I think he sometimes does a little bit of return on capital. So don't just go out and buy this one. Like make sure you read the prospectus and everything, please. So don't, just hear $30 dividend and be like, oh my God, get this, only $2,000, $30 dividend. So you got to be careful what you're buying out there, all right? And I also advise everybody to please don't buy triple X funds and hold them for a long time. Just don't ever do that, all right? They have beta decay, and you don't ever want to hold that for longer than like a week. Okay, now that that's done out of the way, I don't have cash by the way, it's collateral. I only have $1,000 cash right here, and it's gonna be 2,000. Oops, it's gonna be $2,000 cash soon because one of my sorry, Cameco options is expiring this tomorrow, and unless Cameco drops below $10, oh look, two of them. Uh-oh. Unless Chemical drops below $10, I'm gonna collect um well the rest of the money, which is like $6 apparently. I'm gonna collect the $6 and the money I put down. So I'm gonna have another $2,000 to buy more options with and probably re-roll in Chemical. But we'll see. Like I said, I gotta look for a new horse, and maybe this article is giving me a little renewed interest in the precious metals. Um, and here's what he basically says, right? He says a few arguments. There's a few pretty interesting arguments, but they all really revolve around. Um, make sure that I've got the scene here. Yeah, screen capture. I don't want to make that drawing mistake again. You know what I mean? All right. But unfortunately, all of his arguments revolve around the fact that um, the stock market is at an all-time high and the valuations are like super high. All right. So the valuations look something like this. Okay, so this is like 1929. All right, and then for a long time, and then it's like 2001, 2008, and now we're like almost over here. Actually, not that high. We're somewhere around here. Okay, let's extend this to make it more realistic. All right, now we're here. So this is kind of what it looks like. And so his argument is like, well, we're way too high in valuations. What he means by valuations is PE ratio, guys. So PE ratio. Now, what is that? You might ask. Well, PE ratio, if you're a noob, means price over earnings. All right. So how much the price of the stock is. Okay, let's say the stock is $10 and it's earning like $1, right? So it would per share uh per year. So its PE ratio would be 10. All right, simple. Now, private businesses, okay? Private businesses usually sell for like 2.5 PE to, I don't know, 5, depending on many things. Um, but publics, they're like usually somewhere between 6 and it can go very high. It can be like 170, all right? Like, I don't know, Tesla or something. So they can range and I don't know the figure on the top of my head of what it is right now, but they're probably in the 20s maybe at the moment, stocks. And traditionally they're like around 15 or 17, something like that. Now these are just ballparks. I don't have the statistics to back this up. I just know this on top of my head, so take everything with a grain of salt. But that's his argument is that we're really high valuations, it's going to correct, and what's going to happen to the yields of the bonds. All right. Bond yields have kind of come up right now. He says they're going to back down again. All right. Now, yields, this is some financial education right here. Bonds of yields move inversely with the price, all right, of the bond. Okay. So when the yields are high, let's say 3%, all right, the price of the bond is low. So when there's more demand for bonds, this is what happens. Okay, the yield actually drops. Okay, so let's say this becomes 2%. All right, let's make this a bit cleaner. 2, 2%. So it's inverse. So basically, when the yield goes so high, it becomes more attractive, right? So that's how it works. It becomes more attractive to people, and they think that bond yields will return more than the stock market will, right? So imagine that the yields are 13%, and why would you not buy a 13% yielding bond per year if if markets are already so overvalued, right? So if the bond yields are high, you're gonna put all your money into this, and what's gonna happen is the price of the yield is gonna start coming down because there's more demand now, okay? So the price of the actual bond rises because there's more people chasing after it. All right. And what happens is when the yield goes down, okay, when the yield goes down, gold becomes more attractive because let's say inflation is running at 2%. All right. Let's say this is 3% here. Inflation is running at 2%, and the yield is of the bonds is 2%. And like, why would you do that? Right? It's especially if it's less you losing purchasing power over, 1 year. What if the inflation is understated, right? Your cash is just sitting there, not returning anything. And in fact, the crazy part is, right, and then in Europe, they had negative yields for a little bit. So they had some inflation and negative yields, nominal negative yields. So people were losing money by buying bonds. Essentially, people paying the governments getting paid for people to hold their debt. I mean, it's absolutely ridiculous. So like it's like saying, hey guys, um, let me borrow $1,000 from you, and I'm gonna give you back 995. You know, and you'd be jumping at the opportunity, be like, yeah, 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 that sounds such a good idea. I'll give you 1,000 euros, and then a year from now, you give me 995. All right? Yep, good. Shake hands. Done deal. All right. So, anyways, you can see how you're losing purchasing power. So, what holds value really well? Well, gold. Gold does. So this is basically his argument right there. He says that um, bonds are going to come down in yield. Their price is going to go up because the market's overvalued, and investors are going to realize that it's not going to keep going up and up forever. He says that the Federal Reserve is basically kind of done raising rates. So that's another reason why he thinks that the yields are going to go down now. All right. So anyway, another reason that he thinks um, gold miners are going up and gold is going up is because it's so undervalued, right? If you look at 2011, it's like this, and then it's been, you know, it's down here. It's been horrible. All right. So this is 1200 and it was at 1900 during 2011 gold was. So he says, it's so stretched out and right now there's so many people betting against gold that it's going to catch a bid because there are no more sellers left. And the miners obviously are very leveraged to the price of gold and they're going to benefit, etc. And if you look at the PEs of the miners, he says, and I looked at some of their forward PE. Forward PE just means like what the PE is going to be in the future, projected. And he says that the regular stocks are have a lot higher um, PE, forward PE versus the miners, which are like 18 or something. That's an 8. All right, so that's he thinks that there's going to be some inflow in there, and it's just a hated sector overall. Like everybody hates the miners right now because they've been losing money for so long, right? This is 2011, and now if you didn't know, it's 2018. So that's 7 years. Pretty brutal. Pretty brutal. If you've been in the market with me, I've been in and out, but then you feel the pain. Could have been a millionaire by now, guys, but I'm just not because of this. Oh, and I still keep talking about it. All right, but anyway, I might start selling some options against it. I might find a new horse, a new favorite company like EXK. It's been my favorite company forever. But I might find a new one, a more stable one, maybe Newmont or something. But although the options are not selling very, very well for Newmont, but I have to research it. I've been doing some research during the day. Actually, it's been pretty stable. 34. Yeah. Let's see what the options look like. Sell put September 7. What September 28? No. I mean, not bad, but you gotta multiply it by three because it's 30. So I have to put down $3,000 for 25 cents. Uh, it's just a little underpriced. Just a little underpriced for me. But anyway, I'm gonna have to look it up. I'm gonna have to look up more in depth. What else happened here? Nothing much. I mean, just this article was interesting to go through. But other than that, everything else looks okay. Normal. This is normal action. ERG of a percent. Just Apple being a beast as usual. Okay, no more Apple talk. I promised. And that's about it. Okay, I'm stretching this video way too long. Um, hopefully it was somewhat enjoyable. I don't know. But update on the account, up a little bit on the week, receive some dividends. I'm gonna get that put option tomorrow. Gonna collect $6 hopefully, and 2,000 more dollars to play with to buy more options. I'm gonna think about what to buy over the weekend. I will be updating you on that. With that said, guys, that is it. All right, peace out.